Hi, Anne-Marie, how are you?
Very good, thank you, Elaine.
Look who I've brought to our meeting. Ah.
Cute.
You might see her bobbing around. She's so cute, isn't she? Thank you so much for meeting me on Zoom and having a chat with me. So me and Anne-Marie, we know each other. We've known each other for many, many years, haven't we? Throughout my estate agency career. Tell me a bit about yourself, Anne-Marie. Tell me a bit about what you do.
So I'm a mortgage advisor. I work independently. I met you working in an estate agent in the Bolton area, and then I decided that I wanted to take sort of my own step forward, and so I started a company called Mortgage Bird, and I've been running it for about 2.5 years.
Yeah, and I asked you to hop on today and have a chat with me because I've been reading that many blogs and been listening to that many different forums about, post-COVID property. I thought it would be interesting if me and you had a chat sort of around that subject, but in terms of mortgages stuff from a finance perspective, really. So how have you found things sort of post-COVID?
Okay, so on a residential basis, it massively different. The residential market has depleted like we've gone back 10 years, if I'm completely honest with you. The available products, I think it's really killed the first time buyer market for anybody that needs or wants a property within the 10% or 5% deposit. In fact, 5% is a no-go and 10% is so limited. It's unbelievable. When I've looked at the buy-to-let propositions, and actually at 75%, it's quite strong. There are some core lenders out there still, but you've got to imagine at 75%, there's not a lot of risk to the lender, because even if the property did dip, they're not going to lose out. Whereas at 95% on a residential basis, any property reducing, it's a massive effect to the lender. There's going to be negative equity there.
So is that in terms of like sort of new mortgages, so mortgage applications or remortgages, and is it just the same across the board then?
The lenders are looking to retain their current business, so they're offering retention products at the higher loan to value. So if you're already with Nationwide, they will honour a rate at higher loan to value. You can't move to Nationwide as a new mortgage on a purchase or on a remortgage, so moving from, let's say, NatWest over to there, or vice versa. It's it's not just Nationwide, it's across the board with the lenders. HSBC are the only lender on purchases that are really storming it. However, they're limiting it to a chunk of money per day, and between 8 and 9 o'clock in the morning, that allocated fund is gone. So actually, although there are products available, within an hour of the morning, they've allocated out, which means that really we are very, very thin on lending. Virgin Money have come back into the 90% market again, very thin on lending, and Clydesdale, which is a very unusual lender to pull up on in conversation. Other than that, you're going down to 85% products on remortgages and purchases, and actually there's few on there. So you've got sort of Halifax coming in at the 85%, and then you've got like the NatWest market, which is coming in at 80%. So that's vastly different to 8 weeks ago, where I could get you an adverse E-type mortgage at 90% loan to value. It's just crazy.
Yeah. Have you seen any people sort of pulling out of property purchases or mortgages kind of being declined, or were they honouring anybody who was already sort of in the process?
Under obligation, you can't just change regulation. They up to the point of application, they have to keep the criteria as it was. However, I have had a few cases where I've had to have strong conversations with underwriters because they've been trying to sort of pull away from the lending. So I've had to fight a few cases through. But yeah, the criteria change is the most dramatic, and it's all going to be to do with affordability and the way that they assess predominantly self-employed people or people that have been furloughed. And that is sort of my biggest concern. In fairness, over the last 2 weeks, I have had to work harder than I've worked in the past 10 years to place mortgages.
Yeah, I imagine because the goalposts are continually shifting. It's like when you used to know what a provider would accept, it's kind of like, oh, okay, what's your circumstances? Well, which provider can I kind of place you with? And it's, I suppose it's then learning about all the new you know, criteria and regulations and stuff. Because you do, is it whole of market, do you call it, when you're an independent broker?
Yeah, I mean, it's a funny word, whole of market. The whole of market under the FCA, they don't really like to use that turn of phrase anymore. But what that generally means is I, as a broker, can access pretty much all the lenders available. So I have a large panel and I can offer you a number of products depending on what you're looking for. So that's what whole of market looks like. And yes, standardly, my knowledge of criteria was really good. So I could have a conversation with somebody, and then by the end of the conversation, know sort of where I'm going to place you.
Yeah.
Whereas because everything's sort of completely dissipated, every case now is like, okay, we need to really think about it. Actually, the value of having an advisor now is far greater than what I feel it was, or what I think people thought even 8 weeks ago.
Have you seen more people sort of looking to refinance and remortgage and pull equity out of properties, or are people just sort of taking mortgage holidays and thinking, well, you know, we'll cross that bridge when we come to it?
It's a very that's vast, you know. Some people are saying this is a really silly time to do this, property values might go down, should we be taking the money out, should we be looking to extend, should we be doing all these things? For me, I've been trying to allow people to really let the dust settle, because unless you are genuinely wanting to proceed right this second, you are then probably going to sacrifice your loan to value, the deposit levels and whatnot. And I think it's just far harder to get anywhere now. It's a funny one that people are asking the question. I've got a lot of bubbles, people are inquiring, but not quite coming to the forefront. My biggest concern is that on the purchase side of things, the thing that makes, you know, the first time buyers make the circle of the property market work, that even though they had decisions and principles, even though they had approvals in the past, now allocating that money and actually getting hold of that money. I give an example of valuations, actually, because we've got a bottleneck, because we have no valuations since the 17th, physical valuation since the 17th of March. Application went in on the 11th of March. The valuation's been booked in for the 27th of June. I mean, that is just insane. So we've got to get through all that backlog before we're going to see the market starting to settle.
So we wouldn't have seen at the moment any down valuations, would we? Or is it too early to say? I mean, have you had anybody go, oh my God, you know, COVID, take 30% off that, I'm not lending?
It's more to do with them reducing your income over the property value. So because of COVID, lenders are being very, very cautious, especially with self-employed income. It's really hard on a valuation side of things, because the way that the market's changed, they've adjusted the desktop valuation, so they've been really proactive in that. But we're only just coming out of it. So only on Monday, really, were we allowed to start the physical valuations. And like I say, if I've got an application from the 11th of March and it's not booked in until the 27th of June, how can we preempt what the property values look like? I actually don't think the value of the property is going to deplete dramatically. It's more to do, again, with that employment concept. Like, what's the strength of employment moving forward? What's income look like moving forward? And that is the risk of lenders sort of putting the stoppers on more so than the values going down.
Wow, it's changed every week. It changes, doesn't it? It's like there's something else, something that we haven't considered. I mean, they say it's an unprecedented time, and I was thinking, we've been through a recession. I mean, I've worked through the last recession, and so have you. And then it's like, well, are we in a recession? What does it look like? You know, and it's it's different, isn't it? It's got a different feel to it this time around.
Yeah, it's a lot calmer. We've been here before, so when the market, when lockdown was announced, and seeing the lenders withdraw, it very much felt like we were back to where we were 10 years ago when the market
It was
crashed.
scary, wasn't it? For a property pupil, I was like, oh my God, where are they all going? Why are they all withdrawing products? I was like, oh my gosh. It was
Again, a valuable time for to have an advisor on your side at that point. And I think that's what's going to happen moving forward. As an advisor, going to a high street bank or just assuming that you fit is a wrong assumption. Assuming that you think you know what you earn and you think that the lender's going to assess you in certain ways, again, wrong assumption. That lenders are meeting regularly and risk assessing this because it is uncertain. And yeah, we are going to go into that sense of recession. It's a funny concept, that, because we're now focused on potential unemployment, whereas the recession before was to do with the adverse lending and overvaluation of property.
Yeah.
So it's an acceleration that was not, we couldn't sustain the acceleration in property value. Whereas that isn't really what this is about. This is about long-term stability within the working world, and I think that is the most scary thought, because, like I said, how do you control businesses that are going to go out of fashion effectively?
The government's trying to put a lot of stability in place, isn't it? Like with the furlough scheme and things like that. But I'm not too sure if it will put off first-time buyers. If you've got your deposit saved up and you were thinking of buying a property, if you've then been furloughed and you're not too sure about your future employment, you might kind of sit on that cash because you might need it, might you, in the next 6 to 12 months. And first time buyers are the people who kind of kick off the market, aren't they?
Well, they're the circle of life when it comes to the market. They allow people to move on. You have your first time buyer homes, and then you have your home movers, and they are the like I say, the beginning of the circle. I think that it's not to do with people not wanting to move. It's just that they're not going to have enough money to move.
Yeah.
And I think the deposit element, and actually I do think that once, like I say, this bottleneck comes through and we've got all our valuations done, and we start establishing, is there any reduction in value? Only then will we start to see these lenders starting to increase loan to values and make it easier. But I think we're talking very easily the end of July, August, September. I mean, literally unforeseen, which is unknown to me. I have been in the game forever and a day, and I like to understand the patterns, and you can sort of see what's happening. And my expectation over the coming years was that there's going to be a lot of debt consolidation going on, people not moving, people extending their homes because it's so expensive to move. So, but now, even that's going to be rocky. So I'm fearful that repossession is going to come into touch. And although the government are very much helping people with, their support package, it's how we come out of that as a support package.
Yeah.
Like, there's got to be a point where they can't help us anymore, or help anybody, anymore. So that's the concern for me. And I think, again, as a cautious advisor, I would be assessing a first-time buyer and saying, how stable is this for you? You're not pushing yourself beyond your means. It might actually mean that people look to buy lesser priced properties just to give them that sense of, we can truly afford this. I mean, I'm curious to know how the rental market's going to pick up, because obviously if you're a renter, you've got equal risk to not having a job as to anybody buying. So
yeah.
Then we've got to...
When we initially kind of went into lockdown, they had put, like, applications got put on hold. Nobody was allowed to move house in terms of renting as well as buying. And then they sort of said, well, if you're a key worker, you can. If you need to move, you can. Blah 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 blah. But properties weren't coming to market, so I found it was quite a busy time, really, still on the rental front. And the referencing companies and the insurances on the rent guarantee side pulled a lot of their products and then said, we're not offering it, we can't do, we need to just hang fire onto things. and they've kind of opened up in the last week or so, saying, yeah, you know, they're going to offer rent guarantee, and changed around their criteria and stuff like that. I mean, there's still, you know, I've got 2 properties up to let at the moment, and I'm still getting a lot of inquiries. You know, people are from people on furlough. I would say I'm quite lucky for where the properties are. I'm still getting a lot of hospital staff, a lot of key worker staff are still, you know, looking to move. And yeah, it's been quite busy. I'd say it's been just as busy for me, but on the rental side. But we'll see. I suppose it's the rent arrears that are a concern. But then, you know,
I mean, there's going to be a percentage, no matter how you look at it, that fail because of this situation. People are some people need 100% of their income to survive in life, and actually probably live slightly beyond that. So any reduction, if they're on furlough, I mean, from a lender's point of view, again, every lender's got a different perspective. So if you're on furlough, you've got to come out of that because before they're comfortable with giving you some money. Because how do we know that you're going to actually truly come out of it? And I mean, like I say, there's concerns, but then I've spoken to some of my clients who have stormed it. You know, it's actually improved their business, and they've taken advantage of the bounce back loan, which actually isn't necessarily because they have to have it, but because why wouldn't they take it? Because it's the cheapest money in business sense that they're ever going to lend, and it's a stability for the business. Whereas, like I say, some people are just ground to a halt. From my perspective, I feel there is almost like let the dust settle concept. Anybody that really wants to move, and anybody that really has found that dream property or the rental property that really stacks up, then pursue that and move forward. Otherwise, taking a merry little time to just allow the market to get back to itself. And from an investor point of view, the investors that I've got on my books are all gearing up. They're not proactively going out and buying property unless it's cash. And then because the property prices are so realistically good, cash, it means that in 6 months' time we'll be able to pull that money back out, and they're in a strong enough position to do that. And that's a serious investor, you know, to be buying bricks in pure cash. So again, that's a funny market, but all the investors that I seem to be speaking to are just gearing up and waiting for opportunity, which means we're expecting the opposite side of opportunity, which is that repossession market. It's like I say, it's very uncertain. I think just remembering that every week is changing is the fact. And I think, like I say, if we focus again next week, I promise you there'll be different things to talk about.
There will be. There'll be about 100 different things to talk about, won't there? I mean, we've not even touched on half the things we could talk about, Anne-Marie. I know that. And it's just we just need to keep in touch, don't we? You know, speak to your broker, keep speaking to people, have those conversations, see what's happening in the marketplace, and check over your statistics. And I mean, at the minute, if you're buying a property, or if you're renting a property, anything cash wise, make sure you know what you're doing, do your homework. I mean, we can't predict the future, can we? We don't know what the market's going to look like, but we can err on the side of caution, can't we? And take
I think so. And I think seek advice. You know, I struggle with people going to their banks directly, and that's not because I don't, you know, a bank is there to do a banking job, and that is pretty much to make money out of you. So when you're looking to invest, whether it's on a residential or a buy to let, you know, speak to the relevant people, get the right team around you. Having, you know, you, Elaine, to make sure that you're making sure that property is stacking up for all your knowledge and experience, and then making sure that the finance makes sense. Just because your bank says something doesn't mean that I might not say something else. I had a client come to me and said, I went to Barclays and they said I need a 40% deposit as a buy to let. Now, they might, I mean, I don't actually think that's right. So why not speak to somebody that's independent and make sure that you're getting the best advice? And that's the difference between, again, myself and you, and necessarily going to an institution mindset that is there to effectively, I mean, make money out of you. So again, seek advice, make sure you're getting the best advice, make sure you're doing your homework, and that you're considering all the options, because there are options. Some of them you might not be happy with them, it might be not what you want to hear, but at the same time, if you've got somebody that is working on your behalf, I think is really essential in this particular market.
Yeah, chat to the people in the know.
Yeah, and ones that are not I'm regulated under the Financial Conduct Authority, so I'm under obligation, but at the same time, I also know all the lenders, and the same principle for you. You know your market very differently to a lot of people, and I think just making sure that you're utilizing the knowledge. This is your full-time job, this is my full-time job, we do this all day every day, so you can have a really logical, sensible conversation with us, and we're only looking for the sensible advice. We're not looking just to do it for the sake of doing it.
Yeah, cool. Oh, thank you so much for your time, Anne-Marie. I really appreciate it. I love talking to you and catching up with you. And I was so glad that you got to meet my kitten, because you haven't even met her. I should be like the star of the show. If you want property advice, just have a little chat with this little one.
Right,
so yeah, let's catch up again, and we'll have a few more chats about all the changes that are sort of happening in property. And if people want to get a hold of you, where can they find you?
I'm on Facebook, it's Mortgage Bird. I have a website as well, mortgagebird.org.uk, and I'm easily, it's Anne-Marie Fowler, Mortgage Bird. You can Google me and you'll find me. I'm also on Vouched For, so you can look at the clients and what they say about my service. So yeah, thanks very much for that, Elaine. Really, really appreciate it.
Oh, fantastic. Take care. Speak soon.
Thank you.
Bye.
Bye.
Bye.